our deficit's going to be a bit larger, but the tail off is going to be much stronger than it previously was. And when you look at the, the government debt levels, what we'll peak at, that'll be well under 30%. And when you're in context with some of the troubled economies in Europe, they're well over 80% and some over 100%. So, exactly. We're at a point where
we come out looking pretty healthy, don't we?
Well, exactly. We're cutting taxes. Where other countries have got people on the streets rioting because they're cutting spending and increasing taxes. So, yeah.
We should really thank our lucky stars that we have such a good debt position. Over the last decade, governments from both sides have cut debt, and our budget deficit as a percentage of GDP is around about 3 to 4%, compared with 10% in countries like the UK and the US.
Exactly.
When the bond vigilantes, those markets who gang up on governments and tell them to cut their spending, they're not going to be looking in our direction, which is a great thing. We really should thank our lucky stars that we have a good budget deficit situation, and that we're right next to Australia, which is doing so well out of the Chinese boom.
Absolutely. But Bernard, do you think there is potential for this to backfire on us in terms of these tax reforms actually increasing inflationary pressure?
Well, inflation is one of the concerns, particularly this year. With the increase in the GST, with the emissions trading scheme, and with the increase in ACC levies, we're looking at inflation going well over 5% for this year alone. The Reserve Bank, though, will be able to look through those changes and see them as one-offs and hope that it doesn't catch fire, that people don't increase their inflationary expectations. Some interesting stats out in the last day or so from the Reserve Bank on inflationary expectations. They are building. And what it does say is that the Reserve Bank needs to increase the official cash rate. It will probably do it on June the 10th or on July the 29th. The official cash rate will go from 2.5 to 2.75%, according to many people in the markets. And that will, of course, push up borrowing costs for many farmers who have their borrowing costs linked to perhaps the 90-day bill rate or some other variable rate like that. So something for farmers to watch. Inflationary expectations are an issue as long as the Reserve Bank moves fairly quickly, and I think they will. Now,
the Eurozone crisis, Bernard, is still big news, and I imagine it's going to be for some time yet. Stocks are tumbling, currencies are falling, and there are still concerns about what this means internationally. These are not stable markets, are they, by any stretch of the imagination? Why is the market reaction to the bailout in Europe been so cool?
Because people realise that you can't solve a problem which is produced by debt by adding yet more debt, and that's what Europe is trying to do. Also, there's fundamental concern about the stability of the euro. What's happening here is that Greece and Spain and Italy and Portugal, the pigs as they call them, they've been running big budget deficits and essentially using low interest rates produced by the Germans to continue to run those deficits. Now the game is up. Everyone's going, it's possible you could default on that debt. The Germans are saying, okay, we'll bail you out for now, but we're going to force you into potentially a deflationary spiral with cutting spending, increased unemployment. And that means that Europe as an economy looks to be dead in the water for several years yet. And there is a risk that if the pressures become so great on the likes of Greece and Portugal and Spain, that they may be ejected from the euro. When that happens, the banks who have borrowed money from each other and have also lent money to these governments down south will face big losses. And that's why we're seeing at the moment continual growth in credit stress in the Northern Hemisphere markets. The key thing to watch is the LIBOR, the London Interbank Offer Rate. In fact, there'll be some businesses in New Zealand who have their interest rates based off LIBOR. That LIBOR rate has risen to a 7-month high, and that's because the banks in Europe are particularly worried about lending to each other. They worry that the other bank who's they're going to lend to might be hit by some big losses on the sovereign debt, and that's why we're seeing stress in the markets continually rising. In some measures, it's almost as bad as it was after the Lehman crisis. So farmers and anyone in business in New Zealand should be watching what's happening in those Northern Hemisphere credit markets, because that stress eventually flows through into higher interest rates and more cautious lending by all of the banks, not just in New Zealand, but in Australia and the rest of the world.
Well, James, that actually sounds quite worrisome. That's very depressing what you're saying there, Bernard. But, James, where is the euro currently sitting at? It's lost about 20% of its value in recent months, or last month or so, hasn't it?
Yeah, but, I mean, it might even be close to 30%
Really?
at one point. You know, we were sort of down in the 40s, in the low 40s, and got up to 57 against the euro, so we have pulled back a little bit over the past few days.
About 54 at the moment, isn't it?
Yeah, about 54, and I guess we've seen people running away from the New Zealand dollar and into other currencies. So, but you know, in general, that Bernard's pointed out that there are some real concerns about the European economy and the euro currency and what those effects will be, and that's why we've seen it so weak. Initially, there was a bit of speculation that the euro might become the new the reserve for the globe and take over from the US dollar.
Don't think so. Now, can we just shift away from that depressing scenario onto the Crayfer farms? The Mei Wang-led consortium has put in a bid to buy 16 of these farms, a deal worth approximately $100 million, but still needs approval by the OIO. Do you see that going through, Bernard?
Well, in the past, the Overseas Investment Office has been seen as a rubber stamp. Just about everything gets approved. But they are looking at this one a lot more closely. There's obviously a lot of political interest and real questions about Mei Wang herself, given her history with the Dynasty Group, which failed and which was liquidated. She herself is before the courts on various Companies Office charges, and there are some real questions about whether she has the ability to manage 16 farms and that the people around her are able to create this vertically integrated business she wants to create.
Because they're talking about processing factories and all the rest of it, aren't they?
We're talking about UHT plants, we're talking about supply lines into China, distribution lines into China. Mei Wang is at best an entrepreneur. There is no suggestion that she has done anything like this in the past. She may have some very good people around her, but there are real questions about whether that can be sustained. And I don't think it's a done deal yet that this will go through. The receivers have done a conditional deal to sell the farms to Mei Wang's UBNZ, but have said if we get better offers from someone else, we'll take them if we don't have OIO approval. So still some doubt yet about whether it goes through.
But with this whole Mei Wang thing, James, do you think we've opened up a bit of a can of worms over our free trade deal with China? I mean, after all, we're doing business in China. Should we be expected to reciprocate and allow them to move in here?
Well, I guess it comes down to you know, what's going to be good for the economy, and you know, by us moving into China, we're exporting product to China. You know, potentially the proposal was that they're going to come here and own our land, and you question whether you know, whether they're going to be better farmers than we are. So you know, in terms of Fonterra have got some farming assets in China, then you know, we regard ourselves as top-notch farmers, and that's why we've gone to China.
Exactly.
So you know, in terms of the free trade agreement, then yeah, it does open things up. But you know, as long as we're exporting product and you know, not getting into asset sales, then you know, I think it's a good way to go.
Well, up next, we ask our guests, where to from here? Welcome back. Well, it's been a good, lively discussion today. A couple of points of interest to me. Bernard, to you first, just going back to those budget tax changes, or I guess we could even call them reforms, really. They're the biggest thing since the mid-80s, really. Businesses will lose their ability to claim depreciation on their buildings, and one tax expert estimates that it'll cost millions to rural industries, not just to farmers, with the likes of meat processing plants, dairy factories, cool stores. There's a lot of building out there in the country, isn't there? And that he makes the point that, of course, they reduce in value over time because they're purpose-built, and by the time they reach the end of their lives, they're not worth anything. Do you think the government will listen to the lobbying, which will no doubt happen? In fact, the meat industry's already said it's going to be getting in their ear.
Yes, well, there is going to be pain for the government in this from the business sector, certainly in commercial property ownership, not just in the rural sector but elsewhere. They will be arguing against it. But remember, the government had to find some extra money here to spread out across the population to compensate for the increase in the GST. They got it in part from rental property investors in the cities. They also got it from foreign investors through the thin capitalisation rules, but they had to get it from somewhere else. And this is part of the thing. This is a comprehensive tax reform. Money is being shuffled from one part of the economy to the other, from one group of people